Alright, welcome back to another video, guys, and in today's video I'm going to be doing a quick little trade recap with some tips and tricks and examples of course, me utilizing the impulse model that I teach you guys within the course and mentorship. And this is some quick examples of how we should be expecting price to really deliver when we're trading these, and basically a simple way to manage your trades better when we're trading the impulse model. And I did not manage them well today, but I'll explain the reason why. So today I was just trading 80 session here. It was a very small day. I took one loss and one win. So one win for about 3.6 RR, and of course took on a full 1 RR loss. So did not really make much today. But green day is a green day, right? So remember, for impulse model, it is just essentially setting a buy stop or sell stop at the candle break on the 1 minute. Now if you want to use the seconds, that's up to you. I just highly suggest not using the seconds for impulse model. I just don't suggest using it at all on the seconds because it's very little confirmation. And I'll have a backtesting video in a bit on that. But the point is, for impulse model, remember, we need context of price delivery. So the price delivery must be delivering to our PUI with a lot of imbalance candles and a lot of momentum. What this means is there's a lot of fair value gaps. And when price is delivering all in the same color candles, something like this, where majority of candles are the same color, they're all bullish or they're all bearish with tons of imbalances, right? Tons of imbalances. These deliveries must not have a lot of pullbacks. If price is doing something like this and then going back up, it is not a valid impulse model. We want something that's as impulsive as possible, right? So something similar to this or this. These are very great examples of impulse deliveries and when we want to utilize the impulse model, because essentially the logic is when the price is impulsing like this, it's creating inefficiency in the market, where in this leg structure, all the market is offering here is selling pressure. Or not even pressure, sorry. It's selling orders. It's just filling people that are trying to sell. And it's not filling any buy orders. Thus, when the market does hit an area of buy orders, for example, like demand, we tend to come back very fast and reverse extremely fast. Here's a perfect example. My 3-hour trade here was a perfect example of that, right? You can see how we completely dumped extremely fast my TP, and we did not really have price delivering back to mitigate the OB or mitigate anything. It was very tiny, minimal to no pullbacks from the delivery towards my TP and the delivery towards my PUI that I'm anticipating to take a trade off, right? In this case, obviously, we have a very A+ setup here, I'd say. Aside from being counter external, I'll explain a bit why it was actually probable still, even because of that. We have a flip here right above, taking out inducement here, right? Why is this inducement here? Look at this. From this low to this high of our real structure, price never came back to mitigate any PUI above the 50% level, right? What does this mean? This is fake market structure right here, and fake market structure tends to create inducement. We have internal break structure here to the downside. This is just a small manipulation leg or fake reaction. So we do not mark this as a break structure. This is just not real structure, and we sweep all this liquidity to then continue to the downside here. And again, I'll explain real quick why I was saying continue to the downside instead of continue to the upside, because yes, we were bullish, right? That's why I took a loss here. So another thing is, for an impulse model, you guys know we basically enter off the buy and sell stops of the candle on the 1 minute. I don't recommend using a seconds ever for impulse model, because you will get like a really good risk reward with the impulse model on the 1 minute. There's no need for you guys to get like 1 to 22 risk reward trades when you can get a 1 to 6, 1 to 7 with the impulse model, with the right conditions in TP, right? So there's just no need for that, and the win rate's of course going to be lower if you're taking these impulse entry models on the seconds. I just highly don't suggest it. It's not enough confirmation in my opinion. Seconds, taking like an IFVG and an OB entry model is completely different than taking a straight up candle break or impulse model on the seconds. It's completely different. Two different types of win rates right there and confirmations. But nonetheless, again, it's just a buy stop and sell stop. We're not waiting for the candle closure. You can if you want. You're just not gonna get the best risk reward. Like, instead of entering on a sell stop below the candle, you could wait for like something like this, where candle body closes below, Sure, that's more confirmation, but you're not going to get the risk reward. And from my back testing, it's better to have that almost double risk reward than wait for that, because if we can confirm the narrative of price and we confirm that we did have an impulse delivery towards our POI, we can expect price to go very fast towards our TP and not really come back. So this brings me to another point, which is how should you manage your trades for impulse model. So for impulse model is actually quite different on how we manage our trades and how you could manage your trades with impulse model. It's because of how price delivers with impulse model. It gives you the ability to manage your trades extremely aggressive, because if this is a true impulse model and we're truly creating or delivering real structure to at least back to 50% of the range, not inducement like this or a manipulation leg like that, then we should expect price to go very fast with momentum and minimal pullbacks, right? Therefore, for impulse model, what you can do is you can have a very strict break-even system. You can break even. I mean, you're basically not going to have much internal structure on an impulse model, right? Since typically it goes just in one straight line towards your TP if it's a true setup. But what you can do is just break even at 1-to-1 R. As soon as price goes in direction of 1 R, like static 1 R, you just go immediately break even. Or if you can, try to find like a break even point of internal structure. I would say this is way too close personally to break even, because this is basically at your entry. You could probably find like another small tiny internal break structure if you want. That could be like a break even point, but as soon as price basically goes in your direction at least 1 R, you can literally go break even. Why? Because again, we're trading the impulse model here with impulse, and price should be delivering impulsively towards the TP. Otherwise, it's likely a fake out and a manipulation leg. And if it is a manipulation leg, it'll come back to mitigate, maybe do some reaction here and then take you out, right? And we should not be expecting price to really come back to mitigate the OB and do some fancy stuff when we have delivery like this. Now, yes, this could occur, right? And it could still hit your TP. It's just a lot lower. Remember, in trading, it's just probabilities based. Nothing is 100% guaranteed in the market. But what I do know is that when we do get a really high quality impulse model delivery like this, it's like an 80% chance that you get a very good trade and it'll hit your TP. So hopefully that makes sense there, guys. Remember, impulse model, enter off the candle break immediately. Don't wait for candle closure on the 1 minute only. And then essentially you can manage your trades a lot more aggressively because we're expecting little to no pullbacks. Hopefully that makes sense there. If not, then try to rewatch the impulse model video. I have like a trade recap for it or something like that. This is what I did wrong today. So the reason why I was targeting up here was because we had previous day high right here. So we were actually bullish on ES. Okay, you can see how we were going from the bottom left to the top right on my screen. You can literally use something as simple as that to determine trend externally. That's literally what we're doing here, right? We're going higher. And so I was anticipating we would take out previous day high and this liquidity. But instead of doing that, we mitigated this PY right here. You can consider this a flip or origin to me personally, because it's very close to the origin, and it's basically, you can even draw it like combined with the origin like this, and it could even just be one basic area for price to react off. But essentially what we did was we actually tapped that origin and we actually did internal liquidity sweep prior to the real move. So if you entered on this OB, you would have lost. But if you waited for the manipulation leg, remember, typically for a higher time frame POIs, we will get that manipulation first. So wait for that manipulation then, and then wait for your entry model, which we had an OB entry model here. If you put your stop loss here, you would have been fine, and you just could have basically rode it down for that trade. But nonetheless, I was anticipating us to at least mitigate this here, if not the previous day high. And that was the correct trade idea. But guess what happened here? We had an SMT. So let me see if I can switch to NQ real quick. All right, y'all, look at this. We had an SMT, and again, I recently posted a video about SMT. I didn't explain it or use it too much prior, but after seeing enough of it occurring with screen time and just a little bit of data and journaling, basically I figured it is something you definitely should be using especially for indices like ES and NQ where there's very high correlation. Now, if you're trading like gold, your correlation asset will be silver, and if you're trading Euro USD, it would be GBP USD. But again, I believe SMT is not really used as commonly on those than main indices like ES and NQ. So I just stick with using it just for ES and NQ because I just never really, I trade gold. You guys know I trade gold, but I just never really looked into the silver chart like that. So I don't have enough data, not enough journaling to really back that up entirely for like specific correlations like gold and silver. But I would say 100% that it is very prevalent on ES and NQ. All right, but now look, what was I gonna say? I was gonna say SMT was ES and NQ. Look at NQ real quick. NQ literally took out previous day high. Y'all see this? NQ literally, like you can go to the daily if you want. It literally took out previous day high right here. And I can't make this up, guys. This is the true power of SMT and proof that really, if you backtest this, it's true. It just happens. It's correlation or asset correlation. You see NQ literally took out the high here and ES did not. Go back to ES. We did not take out the previous day high in ES. This is why my trade failed. I didn't recognize that we had an SMT at this time. If I looked and I had NQ and ES like side by side, or at least I'll switch between the two, I would have been able to spot this SMT here, and I would have known from this point on, okay, now it's time to actually take shorts. As soon as you have the SMT, you can either enter immediately or you wait for a confirmation. We had an OB entry model. You could have took the short here for 2R, or again, if you want better reward, you could wait for a bit more confirmation and have a tighter entry. That's up to you. But literally, if only I had both charts up, but I did not, right? So I failed to recognize we took out previous that high on NQ, therefore ES is likely going to go lower now because previous day high is high time frame liquidity. Remember, the higher that time frame liquidity, the more impactful it is, the more significant it is. That's why my long here failed. If we did not have this SMT, I'm very confident that we would have taken out previous day high. But since we had it, again, this long failed. And again, what did I mention about impulse model entries? You can manage them a lot more aggressively. I did not, unfortunately, for this trade because I was just so confident in us taking out previous day high. But if only I knew and checked the SMT, I wouldn't have had the target, right? So you can see if I did, and I was smart and liked the SMT, I would have broke even probably here, around 1 hour here, because we're trading an impulse model here. We're expecting price to flush towards our TP and not do all this fancy work here. But you know, I held it because I didn't really realize until I got stopped out. I checked NQ real quick to see what was going on, and boom, there was the SMT. So unfortunately here, this should have been a break even here for sure. I messed up on that part. That's a bad execution error. We had a flip right here again, obviously, and I would explain this trade. Enter out the candle break immediately. Remember, stop loss, always have at least one tick above for futures. Just because futures chart, how the increments work, is it can make equal highs or equal lows on futures very easily compared to the Forex chart. And when it does do this, it does not mean your trade is invalidated at all, right? So remember, give it some breathing room for your stop loss. And then we just came back and, you know, we hit TP. We flushed straight to it. It was like, how long was this? About 20 minutes and we hit TP. So I wouldn't say it's an extremely fast trade, but it's because of our time also. This is, what is this? This is prior to kill zone of London session. So, you know, it makes more sense why it took us a while to hit that TP. But, you know, now it makes sense. Everything makes sense now. If we go back real quick, this was literally today, just in New York session. I believe this should be New York session. Yeah, it is New York session. My indicators tell me. Here is a perfect, I want to say, okay, this is not an exactly perfect. Is this a yes? Yes, yes. Okay, yeah, I'm looking at the right thing. This is not the exactly perfect impulse model here, just because you can see this entire leg of structures technically from down here. Now, personally, course, you wouldn't consider this down here as really the leg structure at that point, just because this was prior to open. And look at how price was really reacting very slowly here, and then obviously started speeding up because New York Stock Exchange opened. So you probably would have considered the range from here to here, just because of the volatility difference. You can tell. But even here, this is like a solid impulse model entry or input delivery. This is not the best just because of this here. We kind of want the almost entire leg to deliver impulsively, but I wouldn't be opposed if you took this, right? This is a perfect example of impulse model entry. You can target the low right there. This has been a 6-hour trade here essentially with the impulse model entry. There was one other one someone else brought or mentioned. This is, what do you mitigate here? Might have not mitigated anything here actually, so I don't think this would be valid. There might be something in the 5-minute here. I'd have to check personally, but if there was something on the 5-minute, let's say, this is not the best impulse model, like I mentioned too, just because we had this, right? Yes, we did impulse into the PY, but majority of the leg was not impulsive, right? So again, I'd say that's not as valid. Something very clean like this is what we're looking for really when we're trading impulse model. That's all I gotta say. But yeah, that's basically the trade recap, going over the impulse model real quick. And one more thing I wanted to talk about, if I check my notes real quick for this video, it was about, just real quick, I didn't want to make an entire video just because of this topic, so I'm just gonna make it real quick, include it at the end of these trade recaps. If you guys will watch till the end, you'll learn a lot more, in my opinion. Just know that in each leg of structure, or how price delivers, right? How price delivers, we will always have, you can always expect these types of deliveries. We will either have a manipulation leg delivery or fake reaction, that's what I like to call it, that later becomes inducement, or we will have inducement ran, or we will have the flip mitigated, or we have the origin mitigated. And yes, you can have multiple flips within a range, depending on the range. Sometimes when we have impulse legs like this, typically you won't have as many flips. You likely just have the origin, but that's not always. It really depends on how price delivers. Like for example, if price delivery here, you see, look at this. There's a flip here, yeah, sure, but it's a lot more clear, like where the origin is. Like it's very clear, and you can see this is always imbalance here, really. But if we have a lot of structure, like if we can find something like even here, I'd say this is pretty clear. I mean, this is the origin right here for this leg here, so probably not a good example there. But nonetheless, we have the origin mitigated, flip mitigated. Obviously, we have external liquidity taken, right? But these are all the basically possibilities of the market when it does react. The only time it doesn't react, obviously, would prices pushes straight through a POI. We're not going to really talk too much about that because price doesn't push through like straight through a POI as often as you may think, because it needs to build liquidity. It needs to trap buyers and sellers. That's why the market will give some sort of reaction, even though you're not on the right side at times, right? Even though I was on the wrong side here, the market still gave me a reaction, except this reaction wasn't a structural move. This was, I got caught up in a manipulation leg, right? Manipulation leg or fake reaction. So again, just keep in mind when you're trading that those are all the potential options that can occur. And this is why the IFG entry model that I was teaching you guys for the IFG scalping strategy has a higher win rate. And this is because for the IFG entry model or scalping entry or scalping strategy, you're basically trading the you basically do not care if we're in a manipulation leg or fake reaction or not. While my main strategy, it does matter, right? I'm targeting at least the flip or inducement here. So I'm at least targeting this, or the high. So I need price to actually deliver towards these areas. But when you're trading the IFG scalping strategy, if I see if we can find an example here. There's definitely good examples somewhere here. Let's see. Ooh, those highs got barely taken. That risk reward is pretty bad. Probably not something I would have taken. Let's see if this is, what is this? Yeah, no, that's not good. No bueno. Oh, but basically you guys get my point, right? Like for the IVG scalping strategy, or like any scalping strategy where you're targeting very little RR, or a target extremely close that's not the inducement, flip, or origin, anything that's not within basically 50% of the previous range is considered a manipulation leg, okay, or a fake reaction. So that's why those strategies, scalping strategies, you're just catching the small reaction off the POIs. You don't care if it's a true move or not. That's why those strategies tend to have a higher win rate than my main strategy, except the downfall again is the R. You're gonna have obviously make less R, but you have a higher win rate. This is something that you can choose based on your psychology as well. Would you rather have high risk reward, a bit lower win rate, or would you rather have a base hits of a high risk reward, but knowing that every time you win or lose, it's about the equal size? That's completely up to you. It doesn't have to be equal size, but on average, it will be about 1 to 2 risk reward. Again, the other scalping strategy I basically teach you guys is literally just my entries, except you're just, for example, OB entry model. All you're doing is entering off the OB reaction, but you're just targeting 1-to-1, right? That's another scalping strategy. So I have basically 2 scalping strategies that I've taught you guys so far: the IFG one and the OB entry model one. I would say the IFG one works better just because the only problem with the OB one is you either miss the move or you miss the initial reaction, right? Like this, the price already reacted here off this. Now, I'd probably never ever trade this because look at how big of an imbalance we have right above, and also this counter trend. But here's a good example. Like this here, if you took the OB 1-to-1 scalping, you would have basically hit stop loss very quickly because you missed the initial reaction. But with the IFG scalping strategy, you're catching that initial reaction momentum. So if you have a good momentum like this, let's say we TP, okay, never mind. This is not a good, this is just a loss here. Let's see if we can find it better. Here's a good example, but this one actually was a true move in the market. This was not manipulation. So I'm trying to look for a manipulation lag. Let's see. Oh, here's a perfect example right here. Boom. We never made anything here. Maybe on the 5-minute. Low-key on the 5-minute probably did. But look at this. We had an IFG right here. Body closure above. Checked. Stop loss, where you place it. You can cover the candle or cover basically a few ticks below the IFG. You don't want to have it right at the IFG. Any target basically 1-to-1 or around there, or the internal high, usually the internal high. So you can target that internal high right there, and there's your trade, right? You're catching that initial reaction. Even if it's a manipulation leg, you don't care when you're taking these scalping, using my scalping strategies. But when you're trading, obviously, again, like I said, my main strategy, you do care because your target is not here. Your target is much further, at least the inducement or flip. So hopefully that makes sense to you guys. Again, if you were to take like the OB 1-hour mitigation, you would have took a loss here, right? Waiting for the price to come back because you already missed the manipulation here. You already missed the initial reaction. So I'll suggest, again, if you want to stick with a scalping system, better to stick with the IVG scalping just because you can catch that initial push and you miss less trades, of course. Like here's another example. I actually remember this. This is SMT here that happened. I believe I can check NQ real quick. I believe this was SMT here. But basically, if you took IFG here, entry model, stop loss right below, I probably would have, you could place it here, roughly. And you target internal high. I'd take this bullish candle. And one more thing I was going to mention. Typically for me, I don't care too much about seconds structure. For me, what I care more about is like the 1-minute candles in terms of its bullish or bearish. So what I define as typically, not always, but majority, 99% of the times, basically always, is if I'm looking for like internal high or low, it has to be that. So if I'm looking for internal high, the TP, right, for example, or break, it has to be a bullish candle. Why? Because that represents the close of that price was higher than the previous close. I think that makes sense, right? Hopefully that makes sense. If not, you can just look at the color of the candle, right? A bullish candle basically shows me that this is a significant enough pullback to be considered internal structure. If it's just a bearish candle, like in this case they were both at the same price, so it doesn't matter. But if I could find an example like this here, I personally would not consider significant structure here at all. It's a bearish candle, right? So if we're looking for internal highs, I'm looking for a bullish candle. If we're looking for internal lows, if I can draw an example, if we're looking for internal lows, I'd prefer this to be a bearish candle. So hopefully that makes sense. Why? Because bearish candles are showing a bigger pullback. A bullish candle showing a bigger, more significant pullback. I'm not interested in these tiny fractal because yes, if you go in the seconds, yes, there is of course a pullback here. It's a very tiny miniature pullback because price open here, made the wick, open high, low, close. You guys should have seen that video already. It's in the advanced section of the course if you haven't. Open high, low, close, right? That's typically how a bearish candle would develop. And again, to me, I want a candle of the opposing colors to show me their significance behind price. So either this internal high is good or this internal high here is good, whichever you think is more prevalent. So a little tiny bit discretionary, but majority of times it should be very clear to you, right? Like this high here is good. This high, I mean, you're not getting the risk reward you want. So I would have picked this high very easily anytime, any day. You can see you made a 1.2 risk reward. If you're trading my main strategy, you'd be looking obviously, of course, to target at least the 50% of the range. And for those who are still confused about flip origin, you should not be here at all. Like all a flip is a POI that is not the extreme POI. The extreme POI I call the origin. Makes sense. It's the origin of the move. I just call flips just because I need a name, basically to name them, and they make sense because typically, not always, but typically they align with some sort of structure that gets flipped. If I can find an example, like, okay, this is not an example here. But anyway, I'm not going to get too in depth into it. That's not the point of this video. The point is, if you were taking my original setup, you would obviously target 50% of the range here. Now, if you're just taking the scalp, of course, all you care about is that small TP, and you don't care if, again, like I said, if price is going to create that manipulation leg or if it that real move. You don't care at all. As long as you can get this tiny reaction, that's all you need. This is SMT real quick. I'll show you guys real quick. Monday, April 28th. Guys, don't believe me. Right here. Almost equal lows, but no. We made a higher low here. And if you check the time, it's basically the exact same time here. We made that lower low here. Right, so just hopefully you guys see that there, and that makes sense. So yeah, that is SMT. So you can avoid also internal liquidity sweeps, things like that with scalping, because you don't care about any of that. That's basically it for this video. I have more stuff to cover, and I'll probably just put that in a different video. So yeah, hope you guys enjoyed this video real quick, going over, just recapping again, some concepts for when to use impulse model. New thing is, of course, you can manage your impulse model entries a lot more aggressively than your normal trades. And I mean a lot more. You can really break even as soon as you get that good 1 hour reaction. And yeah, that's basically it for this video.